These conditions are what defines a bottom, okay? Not a top, not a middle, but a bottom. And I think we're in the process of bottoming here, particularly for the mining sector. They're going to be cutting rates aggressively by the end of the year 2024. And the more bearish it gets, the more bearish and negative comments I hear, the more bullish I get. If we get a turn here, which creates a little retail and institutional investor interest in gold, that incremental buying could really move gold. I keep saying this about the commodity sector. The commodity sector is all about supply. Supply is all about capital into the industry. When you starve the industry of capital, guess what? You don't get supply. It's that simple. When I look at it from an investment standpoint, I think to myself, I think I want to be involved in any rare earth opportunity in Canada, US, Mexico, any other safer jurisdiction, okay? The Americans have woken up that they need these materials, and they'll do whatever they can to help support the production of those materials in safer jurisdictions.
All right, Gerry, so what do we have? A dovish Powell, gold at all-time highs. U.S. equities market is also at all-time highs. The dollar index is now down for the year, actually. The GDX is 30% off its 2020 highs, and the same is true for other commodities. Among others, for example, uranium is at a 15 or 16-year high. So I'm kind of confused here because it's neither, the commodity space right now, to me, you tell me where I'm wrong, but it neither feels like a contrarian play anymore to be in some of these commodities. Neither does it feel like it's over. It feels like we might be stuck in some sort of a middle ground position that's kind of frustrating, where the commodity producers are struggling to keep their margins due to, of course, inflation, but also growing red tape, local opposition in some cases, labor shortages and material shortages in other cases. And the juniors, it's a thing in and of itself that they are almost always scrambling for capital, but definitely right now. So what's even going on out there? What do I even do right now?
Well, I think what you're describing is someone hit the pause button on the commodity side. I don't think this is over by any stretch of the imagination. And in fact, I think what this whole process has been for the last 2 or 3 years is a bottoming process, which has not yet fulfilled itself in terms of turning around and for the upside. In fact, I think 2024 will be a definitive year where the commodity cycle turns on and the mining sector outperforms.
Well, it's kind of interesting when you should mention that, because again, some of the producers are struggling with the things that I mentioned, inflation, so on and so forth. Not some, most of them actually are struggling. And then the juniors are struggling for capital. So when you say the commodity market outperforms, where do I go? Like, what subset of the market is going to give me those good returns?
Well, to just step back for 1 minute. I mean, what you just mentioned is all creates issues around supply. We are supply constrained and challenged in the commodity markets, no doubt about it. Whether it's regulatory, whether it's environmental, whether it's indigenous rights, whether it's politically issues, and we've seen that in the press in the last month or so of major mines being shut down. I mean, there are challenges to the supply side of the commodity markets, particularly the mining sector. That is getting worse, not better. So remember, the mining sector is all about supply. When you go through periods of difficult, the industry having difficulty creating supply, you typically are in a bull market for price, and that's not changed. In fact, it's those factors are getting worse, not better. So you're very, very challenged here on the supply side, and I think going forward that will continue. So what's going to turn here? I think we've had a weaker economy here of late for a lot of the reasons we know about. We've had a lot of uncertainty in the markets for a lot of the reasons we know about, whether it's geopolitical, etc. So there are a lot of things that the market's trying to deal with, and there's a lot of angst and concern. These conditions are what defines a bottom, okay? Not a top, not a middle, but a bottom. And I think we're in the process of bottoming here, particularly for the mining sector. And I think the next stage of what we're probably going to see here is an economic environment which is going to be very much favor the mines, the commodity sectors in general, but the mining in particular.
Mm. But wouldn't those fundamental issues that I told you about have to be solved before the market can give any value to the miners? So let's talk about the miners, the producers here specifically, with the inflation, labor shortages, with the growing red tape and local opposition. Wouldn't those fundamental issues have to be solved first before the stocks can move?
No. In fact, it's because of some of those issues the stocks will move and the commodity prices will go higher, in my view. It's that you got to put you're putting a bit of the cart before the horse. The price is really a reaction to the fundamentals, supply demand situation, and all those issues you've raised, which I just mentioned earlier as well, create firm pricing because you have issues around trying to produce commodities at a reasonable price, and the fact that the junior mining sector, the exploration sector, has not been funded here very well for the last few years is just going to again exacerbate the supply side going forward. So demand is not the big swing factor in the mining sector. It's always supply. And so on the demand side, we've had a weaker economy, and that's given a little bit of retreat to commodities. And everyone understands that. So what's the prospect for the economy here going forward? I would hold out to you, if you look at some of these geopolitical issues that have been going on, and that's all about the supply side and COVID and reactions to COVID and the abnormality of what we've gone through, these swings from the COVID shutdown and revival and inflation and interest rates. And it's no wonder investors are sitting back in their seats and not wanting to put money into risky assets. That's understandable. But we are in a process of normalizing that. And it's a bumpy road to normalization to get back to a quote a more normal economic environment, but we're getting there. The last anomaly to this abnormal environment we've had, I believe, is interest rates. Interest rates, which have had their fastest escalation in the history of man, percentage-wise, in such a short period of time, was a reaction to the COVID and the inflation impacts from COVID. So the anomaly today now is how high interest rates are, because if you look at inflation is plummeting. China's in a deflationary situation right now, so they're distributing deflation around the world. And no wonder German inflation has plummeted from 9 to just above 3 now, and we in North America are doing the same thing. So there's been a consensus out there, and this is part of the angst that most investors have had. There's been a consensus that, we're never going to see 2% inflation again. It's always going to be higher. And look at all these labor unions they're naturally reacting to that and demanding higher wages and so on. Baloney. That's not that's not the case. We are on a track now to go sub 2%, probably a lot faster than most people are expecting. And that is going to probably create a situation where the monetary authorities, who are typically laggers, they lag the thinking of the the track of inflation and the economics. They are going to be cutting rates aggressively by the end of the year 2024 and perhaps before that. So if that happens, then all of a sudden we start kicking in to the economics as well. The economy should start responding. And in that regard, I think the industrial sector, which is, if you look at the geopolitical problem issues between China and the US, China is getting no investment for good reason. I mean, it's the geopolitical issues around that. And a lot of that investment is being reinvested in the US economy aggressively into the industrial sector. So I think the industrial sector will be the sector that performs when the rates come down and the economy starts performing better. So it's the industrial sector. That means one thing: demand for commodities and demand, and particularly mining commodities, is going to accelerate going forward. So if demand picks up, and we got the supply constraints on that are ongoing and challenging, that means, I believe, pricing of commodities, particularly the mining commodities, is going up. And 2024 is the pivotal year for this to get underway.
I actually started this off by thinking of, let's talk about gold, but you're actually bringing up a more important point in general, the mining commodities, because in the meanwhile, as all that's happening, copper has had a very good last few months, going from about $3.50 to now almost $4, as well as a few things really have added to the potential for a supply deficit next year, regardless of what the situation might be. Obviously, there's First Quantum's Cobre Panama mine being shut down, in that's what's sort of top of mind. But lesser talked about parties like Glencore, Codelco, and even the country of Zambia are all expecting lower production of copper next year. And it's nothing new, by the way, because their production outlooks have been bad for many years. I believe Codelco, which is Chile's national copper producer, by the way, is now forecasting to have its worst year in over 25 years now. And production has just kept on falling and falling for decades now, multiple. Zambia is at a 15-year low or something like that in terms of production. And then again, other things that I mentioned, Freeport-McMoRan is still struggling with labor and inflation itself in sourcing the materials due to supply chain problems, is what they're telling us. And so Tech Resources is struggling too. Anglo American is struggling. BHP is struggling with local opposition in Chile. The Las Bambas mine is struggling with local opposition in Peru. And so I'm not guessing any of those, by the way. Those are all announcements that those parties have made over the last couple of months, year maybe. And that's only the largest participants in the copper space, right? But there are many other stories like these, with struggling developers and companies struggling to move forward their projects due to lack of financing and whatnot, and so on. And that's all happening in the background. As you said, the Fed potentially cutting rates next year, and so stimulating demand for copper. So one thing I'm thinking about, and I realize I'm talking for too long, but one thing I'm thinking about is, does copper outshine gold in 2024? What do you think?
I think they may run a bit together here, with maybe gold leading for a bit. I think gold may lead us the way out of here, because look at gold has been relatively firm here, and understandably so. And because again, you go back to the geopolitical, look at the buying of gold by all the central banks, particularly China, and that's been going on now for 2 or 3 years, maybe longer, and it doesn't like their demand is going to go away. So if you throw on top of that a decline in interest rates here and the scenario I just mentioned, and investors just start to buy retail and institutional investors start buying a little bit of gold, it's not a big market, right? And that it will pop into new highs very quickly here. And so I think part of the decline in interest rates as it comes, which will be a bit of a surprise to investors, how rapidly it comes down. I think one of the first reaction will probably be gold, and that will probably pop on the upside,
Right.
and because it's not economically sensitive, really, it's market sensitive. Copper may take a little longer; it'll lag because it needs people need confidence in the economy. But all those issues you had with the copper side, to speak about copper for a minute, and the challenges on supply. Normally, in that sort of environment, you'd expect copper to have run already. Well, it didn't, because we've got this sort of seesawing sort of economy, a bit weak. So it's been hidden, well, in this sort of weakish, struggling economy and all these concerns in the markets and so on. But if you emerge into 24, and all of a sudden rates come down and the industrial sector starts to perform and copper demand just picks up a little bit, not a lot, just a little bit, all of a sudden all these supply issues then become front page news and say, oh my God, so and so can't deliver the copper that the market wants.
Hmm.
And all of a sudden you go bing, 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 copper price moves. That might be later in 24, maybe early 25, that you get that scenario unfolding. But I think the first move will probably be in gold
Hmm.
uh, on the upside.
And you mentioned that investments or exposure within the professional money managers to the commodity segment is at all-time lows right now. It's true. We've seen those charts many times. And I'm thinking about those running to the equities because that's how I make money, right? I don't buy physical gold or physical copper. I don't have place to store any of that. I made it sound like I have a whole lot of money to buy physical gold. That's actually not the problem. But unfortunately, but those running to the equities, who do they run to? I mean, what subset of the copper market or gold market do I go in anticipation of that? I mean, well, so it is good for the copper price, for example, that the largest producers are struggling, but I don't feel confident enough to own them given that they're struggling with those situations, right? And while interest rates may be expected to come down, with the state of the junior market as it is right now, the cost of capital is still relatively high for most juniors. So
Mhm.
it seems like both the producers and the juniors are struggling in terms of the companies while the commodity price is going up. So how do I deal with that? How do I get exposure to copper or to gold in this environment?
Well, you're just echoing, I think, a bit of what I was just said just a bit earlier. It will take time for investors to get comfortable with the idea of putting money into a major mine, let alone some junior mining stocks, right? Or to put money into the commodity sector at all, because it is a higher risk investment. So it, it won't happen quickly. It'll have to happen. What'll it's the old story, Oh, that the grass is greener across the valley, right? Well, it's right. The reason it's greener because the market's moved, right? And I'm sitting here with a stock that hasn't moved, but that one has. It'll take some performance, I think, in the capital markets in terms of the junior stocks, the mining sector in general, and commodities in general. It might take a few months before all of a sudden the general market starts coming around and saying, oh, that's why it's moving, because the fundamentals are actually moving it forward, right? And then the confidence builds, and then you develop into an extended bull market, right? But it look, there's enough uncertainty in the world today and angst in the world today. It's not going to happen with a blink of the eye, right? And if you look at this process we're going through in the mining sector has actually been outperforming, has done a massive bottom for the last 8 years against the S&P, right? If you look at commodities, they've done a beautiful bottom starting in 2000, and it did a little setback here, but it looks like a good bottom. The valuation in the mining sector is at record lows. So you've got all these things lined up, right? That if you get just a small incremental change in the economic background that favors commodities, you can see a wonderful extended bull market, I think, in the mining sector,
Hmm.
because no one's invested anymore. They've all forsaken the sector because of the risk and so on and so forth. But I think if you just a few things go right here in 2024, I think you'll see a lot more investors, institutional and retail, start to pay attention to the fact that this sector is attractive on all levels, valuation, technically, relative to the market, and from an economic standpoint.
Hmm. When you mentioned that the sector is attractive on a valuations type metric, I assume you're talking about relative valuations based on one of the charts that you send me. Well, actually, pretty much all the charts that you send me say the same thing.
Well, yes, no. Well, if you look at the EV to EBITDA, right, of the mining sector, uh, it's as cheap as it was in 2009.
Mm.
And you haven't seen these levels of valuation in the mining sector. These are you know base metal producers. But and then you look at the price of copper. You've never seen the copper this high and the valuation this low. So there's a disconnect, and I think there's mean reversion potential here.
And then some producers, I get that. But if I want to get a little bit more leverage and I go down the quality trail or up the risk trail, if you will, and look at the developers, for example, that have, let's say, a very high NPV and a very low EV. I'm thinking, how do they get out of that bottleneck? Because if their market cap is very low, but they have, maybe they have a $1 billion asset that's going to take, let's say they have a $2 billion asset that's going to take $1 billion to build, but it's $100 market cap. How do they deal with that bottleneck? And are those attractive enough for a generalist investor to put their money in? Those are all things that I keep thinking about, and yeah, I mean, I don't know. How do you think about that sort of companies that have a high NPV with a high capex but a low market cap?
Well, the challenge for the industry has been funding for a few years now. And this valuation example is just a benchmark for value for the industry. If you go down the cap scale and down to the juniors, I mean, they are struggling, and they're even cheaper. I mean, because they have a much higher leverage on this market move on any kind of improvement in the market than any other sector, the junior mining sector, because they've just been starving. So I think what we're going to have here is a market that the investors are going to say, after some outperformance, and probably has to be some pretty good outperformance, they'll come back to the market. But until then, I just think we're going to be challenged. If you look at the financing, the whole gambit of the mining sector's financing challenges of the last few years. I mean, producers that are trying to develop a mine, have been having to innovate financing techniques to get that done, diluting their stock more aggressively than they would like to. It's been challenging. What will break that cycle is better performance out of commodities, better performance out of the market, so that they can actually fund at more reasonable terms, and both in terms of debt and equity. So right now it's hell frozen over from a funding standpoint for the mining sector, particularly the juniors and the ones that are developing projects. So an improvement in the market performance and the ability to raise money will dramatically change that. And then that'll take you to the next stage of the bull market, where the general investors and general market start to appreciate the opportunity that's going to come in the going forward years. So, but we've got to break this ice here. And there's no doubt that we're still in a quagmire for funding for the sector. But that's the nature of a bottom. I mean, that's what happens at the bottom of the markets. Nobody cares, right? So, and the industry suffers until it changes. And I think what I'm trying to point out here, I think we're setting the stage here in 2024, where we could see this change evolve, where we evolve into a bull market for a money sector.
I'm also thinking, what else could break that ice or get the cycle going might be M&A. Why I'm saying this is because these assets are basically, the high NPV, high capex, low market cap assets. They're sort of trading at the assumption that the asset is not going to go anywhere because there's nobody to buy it unless the management team is exceptionally well connected, sort of your Ross Beatties, your Lundins, or whoever else it might be. Those assets typically already trade at a premium because people expect that they are going to get them sold or developed one way or another.
Right.
But about the assets that don't have those exceptional management teams, but have okay or good management teams that are not going anywhere, what can basically improve the anticipation for the value of those companies is if M&A ramped up. And so if you see all their neighbors being taken out, you could start thinking, but so my company here is making the chance to potentially be taken out as well. And so, yeah, I mean, do you think M&A ramps up with the commodity prices going up?
No doubt about it. And I can only tell you from my experience in the last few months that the smart money is positioning itself. And the smart money, the Lundins, the Ross Beatties of this world, they see what's going on, and that smart money does position itself relatively early. And I think that's going on now. And yes, you should see M&A activity. That's part of the survival mode that companies have to go into in these challenged funding markets environments like this. And has been going on for some time, and probably will for a few more months, until you, as I said, break the ice and the general market starts to bring some funds to the industry. In the meantime, it's lift yourself up with your own bootstraps, do M&A, bring in some smart money, merger and acquisition activity. That is what's been going on and continues until you get a better market environment. But I think we're going to break the ice here in 2024 in terms of a changed market environment for the mining sector, which will increase their funding capability at all levels.
What is that dependent on? Because the M&A that we're seeing right now is just not, it sounds horrible, but it's just not exciting. I mean, there's nothing big is being taken out. There's no $2 billion takeouts. There's barely any of that. And what does that better environment look like to get BHP, to get Rio Tinto going and make these, big eye-catching takeovers to get the market starting? What is a better environment for them?
Wait a minute. That sort of activity doesn't happen at the bottom. You're looking at the wrong, turn it upside down. That's what happens at the top. Okay. All these major acquisitions occur not at bottoms, they occurred at tops. So the fact that we've not seen that now, I think, is a reason to be bullish, because it's telling you we're at a bottom, not at a top. And so what I was just trying to describe to you is that you self-finance, you innovate, you have to M&A, you have to do whatever you have to do with your own bootstraps to survive and move the project forward. That's what we're in right now. The big guys won't play until the cycle is, I think, maybe 2, 3, 4, 5 years from now. When the cycle is, we're going to have this conversation in 4 years, and all of a sudden we're talking about BHP buys so-and-so, tech buys so-and-so, someone buys tech, someone does, you got merger acquisitions, chock-a-block for a few months. That's the time we'd have a different kind of conversation. I'd be talking to you about, look at the market's rolling over here. Look at commodities have had a run and looks like they've outperformed and they're going to start underperform. I'll start painting the other scenario for you. Okay, the opposite of what we're talking about today. So I think we're a long way from that. And in fact, I think you have to be bullish because it's so bearish, quite frankly.
Is that timeline that you just gave me just an example, 4 to 5 years, or is it what you think this is going to look like?
Well, look, if you look at cycle, look at the last time commodities outperformed, from 2000 to 2009, 10. That was 10 years, right? I don't think it'll be quite that long necessarily. If you look at the outperformance in the mining sector in that they ran for about 10 years. It outperformed the S&P. And then you had valuations, going from I've very, very low to very, very high. I give it 4 or 5 years. It could be longer because this has been so bearish. So the longer the bear, the bigger the move. Okay, the bigger the base, the bigger the move. Right, the bigger the angst, the bigger surprise, the more people that go and the higher it goes. About 4 or 5 years, I think that's a reasonable time frame. So that we'll start seeing, and then we'll see all the topping sort of activity and a lot of things we just mentioned.
I heard an argument. I'm happy you're bringing up the previous big cycle, really. But I heard an argument on a conference a few months ago that the most that significant commodity bull market, with the one from I believe it was 99 to 2011 or something like that. It struggled with a comparable situation for the stocks where they weren't moving before 99, even though the thesis was there. But only that time around, ETFs were kind of still of a new thing. So a lot of excitement around those basically saved the commodities, that the equities. So the commodity stocks.
Right.
That was what the argument was. At this time around, we don't have anything as significant as a development of a new investment vehicle or something that therefore these companies will keep on performing badly no matter what happens to the prices of the commodities. That's sort of the argument that they gave. What do you think about that?
I just think that's another notch in the belt of a bull market.
How come?
Because when people start creating, um, you know, when the market gets negative, it feeds on itself, right? And so the negative creates a negative, creates a negative, creates a negative, a negative, and everyone, and all self-supporting. It's psychological, right? Oh, it's bad because I heard it's bad, and it's going to get worse because I've heard it's bad, and it's bad because it's going to get worse, and it tumbles. It's a tumbleweed. It just all over yourself. You've got to be negative because everyone's negative, right? And these scenarios, it's the same at the top. I'm bullish because I'm bullish, and I don't want to leave the party. It's having too much fun. No one leaves the party early. No one gets into the bull market early, right? That's why the smart money comes in early and leaves early,
Right.
right? And the bulls. I just think the more negatives you throw at this market in here, I think the bigger this bull will be. Okay.
Right.
And talk about ETFs. We do have ETFs now. Okay. And that is one of the channels, okay, that's probably going to feed investors as this bull market gets going. So the average retail investor has a place rather than buying a direct stock, which is kind of risky in the mining sector, especially a junior. They have an ETF they can go in and put some money into now. Okay, so the channels are there for the capital. Okay, that's which wasn't there the last cycle to the degree it is today. So I think once this market starts to get going, I said this and I'll say it again. Investors like the greener pastures across the valley, which they're not in, right? They say, oh, I'm over in this side of the valley, but boy, that looks really good over there because they just had a 20% return in the last quarter. What's that? And then they start migrating, right? Well, they've got a channel with these ETFs to easily migrate into the mining sector. So I think that will feed part of the bull once it gets going here.
Mm. But then I can go back to the question that I previously asked as to what do I buy? Where do I go? Because if you expect the generalist money to come in through the ETFs, then I basically look up the largest ETFs and buy the top holdings, at least for the first leg up in the market. Does that sound reasonable?
Sure. Look, when you go from a bear market like this to a bull, you pick your poison. Depending on your risk parameters, right? Of course, the smaller cap and the more junior, the higher the risk, but the higher the reward too, right? And I'll give you an example that there's, I do a lot of funding in the junior mining sector, and the last few months it's been bifurcated. 95% of the market can't get funding, or it's difficult to get funding on the very small junior exploration guys. However, there are 3 or 4 exceptions of junior mining companies that have put together the right combination of things, and they've gone up 3, 4, 5 times, and they can get money. They're being overfunded by the market because everyone likes the story. That bifurcation typically happens right before the bull market starts. In other words, the market started to identify some of these, even the most risky sectors of the mining sector, and putting money into it, right? Whereas the whole industry in general is still struggling, right? That's an indication that, okay, there is an appetite for junior or high risk junior mining sector stocks selectively right now, right? Well, that's whereas a year ago there wasn't the best junior mining sector stock couldn't get the attention at all. It is getting some attention, and I said to you earlier, some of the smart money is pre-positioning itself here. That the known smart money is already positioning in the mining sector.
I think it also maybe has to do with the ability of management to tell the company's story. What I mean by that is maybe to quote Buffett here is that risk comes from not knowing what you're doing. And this is a complicated space to knowingly deploy capital in, because it's the normal stocks only would normal stocks have risks too, right? But it is like normal stocks only, or like broad market equities, but it's only with a few added layers of complexity. Whereas everybody understands what a self-driving car might be, or what a phone maker sells. Not everybody understands what a PFS stage epithermal porphyry is, right? And even fewer understand how a plot of land in the middle of the Sahel Belt in Africa can be financed and developed properly into a cash flowing machine. So it is, I believe, the management's task to inform those generalist investors in a way that they can understand it, so that they can feel, okay, I understand this enough, therefore the perceived risk is going to be lower. Am I making any sense?
You're absolutely right. It is one of the great challenges that the industry has. It is a very complicated business model because it's fraught with geology, and geology is a risk all by itself. Let alone the how do you create a mine? How do you finance it? How do you get the regulatory? I mentioned that list of other concerns a little earlier. Regulatory, indigenous rights. There's a gauntlet of challenging business issues that have to be managed, and it is difficult, extremely difficult, and therefore the best of the best minds need high grade, open pit, all the sort of things you'd like to see from a geological standpoint to catch the attention of investors. And you're right, it takes skilled management to navigate all of those issues and communicate them effectively to investors.
Yeah,
It is a challenging business. There's no doubt about it.
right. Which is also maybe the reason why promotes kick off a bull market most of the times aggressively, because the management is just, unfortunately, in some cases, they just frankly lie to investors about whatever's happening, whatever they have, by maybe not lie, but not giving them the whole truth. And you mentioned something there that is, high grade open pit. Those are the easy things to understand, and those are the things that basically remove risk or perceived risk from your investment. But something else that is also top of mind with the geopolitical issues right now is jurisdiction. You're mostly active in Canada for a reason. You've told me that before. But is that also how you expect those generalist investors who would come into the space to act as well? Like, do you expect to see higher valuations in a quote unquote safer jurisdictions, like Canada or North America in general, relative to, say, Africa and South America?
Let me answer that question just 1 minute. This was one thing that you mentioned a little earlier I'd like to comment on.
Sure.
One of the things that's happened here in the last few years is because there's been consolidation in the industry. I believe the quality of management teams has improved. I think we're past the days of the pure promote. Okay, that won't wash in this market going forward. I don't believe that we're in a. The market is too smart. There's too much information out there today for a pure promotional story to work. Okay, they may happen. Some great promoters may be able to survive, but it's a small fraction of what it used to be. And I think the quality of the assets, the quality of the management teams has greatly improved in the last few years. So I think that's a really important point to make, first of all. And sorry, you're repeat your question for me again. Sorry.
Sure. No, I was basically thinking about what part of the world do you think is going to outperform it? Are we going to have a premium to the North America type of jurisdictions in Europe relative to your Africa and South America?
What I think has changed here in this cycle versus and even the one in 2000 to 2010, the geopolitical. The geopolitical is really driving a lot of this. It's like the greening of the economy. That's driving a lot of the minds for EVs and other things. the geopolitical is also driving investment into, quote, safer jurisdictions. Obviously, Canada, US, Mexico, the North America, Europe, uh, this is one of the big changes that's happened for this cycle. Okay, so no doubt about it. Yeah, I think people will pay a premium for good jurisdictional plays. However, I I just harken back to when we get late in the cycle here. I'll tell you, I think people will be by the end, people will be sort of putting down their guard a bit and starting to play the DRCs and other jurisdictions which are less stellar once we get late in the cycle.
Hmm.
So I just think that human psychology is what it is, and market cycles are what they are, and that when you get late in the cycle, everyone starts to ignore a lot of those concerns they had at the beginning of the cycle. Let's
Right.
make that comment too.
But from what you're telling me so far, it sounds like just the beginning of the cycle is going to be the top holdings of the ETFs, the safest jurisdictions, the most obvious bets. And then later on because you said this is a 4 to 5 year thing starting next year, then later on in, let's say, 3 to 4 years, that's when the more smaller caps, maybe higher risk down the quality trail, but also the more risky jurisdictions are going to start outperforming. Am I getting sort of your view of the sector correctly here?
Yeah, I don't know whether I parse it, slice and dice it quite that accurately. I think because for example, the junior sector has been so pounded, uh, the junior mining sector. I think it'll surprise people how it bounces and moves forward, especially on good management teams with good assets. Um, I'd make this prediction to you that some of these really good positioned, good asset explorers with great management teams, you're going to see 20, 50 baggers out of these moves. I
Right.
mean, before this cycle's over, from here to wherever the end of this cycle is, you're going to see some major, major capital gains created in this industry in general, but in the junior exploration area in particular, because it's been so decimated here in the last few years.
Well, that's a statement worthy of a headline. 20 and 50 baggers. Those are just getting me dreaming. So,
Yeah, it's just the nature of it. Gets so bad, it's good,
mm,
and then when it's good, human psychology is what it is. It's
mm.
that's what we're dealing with a lot in the markets today, and we will going forward. And it's just all perception of risk and reward. And everyone's got their guard up now. They'll put their guard down, and the market will unfold, and we'll have a pretty good looking cycle, I think, from these conditions.
How long have you been doing this for again? I mean, how long have you been in the junior market for?
Oh, well, look, I've been in the investment business for 45 years, and I've invested in all across all sections of the markets, but particularly in the junior mining, junior smaller cap sectors, growth companies, technology, and so on and so forth. What's common across the board with a lot of them, and that's why you see this um, in the market, is when market psychology gets negative, it doesn't just hurt the junior mining sector or mining stocks in general. It hurts all smaller cap, riskier investments, earlier stage investing,
Mm.
let's call it. And because that's just the nature of the markets and then investor psychology. So they all tend to move together. Like trying to fund a good medical technology company or a good junior tech app or something like that today has been challenging for the same reasons. So they tend to wax and wane with the investor psychology, and whenever it gets, from my experience over the years, I get bullish when everyone gets so bearish. That's when I start digging deep and looking very carefully at how and when will this cycle turn? And the more bearish it gets, the more bearish and negative comments I hear, the more bullish I get about when that the market, when it turns, is going to be bigger than everyone's expectations there would be.
But so 45 years, you've seen a couple of commodity cycles, two or three, yeah, something like that. Is it ever different? Like, is it ever not how you expect it to be, or like how you're telling me right now that it will be?
Every cycle is different. I mean, the nature of each cycle, the reasons for the cycle, the reasons it starts, the reasons it ends, they're all different.
Mm.
But what's not different is the investor psychology around them. The bearish conditions at the bottom. Here's the way I look at the world. The world of investing is 90% of the time, the market is a gray situation. I could sit here and talk to you, and if we're in a sort of a gray period in the market, somewhere in between the bottom and the top, and I can make a prediction, and I could be 50% right or 50% wrong because it's gray. There's no fine lines. I mean, I could be, opinions are opinions and doesn't really matter. 5% of the time, when it's black and like it is right now for the mining sector, it becomes black and white. It's clear. The definition becomes clear when things get so negative, right? Same at the top. When everyone is long at the cocktail party on their fourth drink and don't want to leave, the conditions are very clear at that point too, that boy, this is shaping up for a top, right? So, but everything else in between, and that's what makes in the investment business a crazy business, because there's a lot of talking heads right around, oh, I think this, I think that, I think this. I don't listen to them unless I think we're at a very extreme point at the bottom or top. Then now you can make some money out of taking a contrary view, right? The in between, you could be right, you could be wrong.
I hope, and I think it comes with experience that, for example, sort of where I'm frustrated right now, seeing the S&P hit all-time highs every day, and my stocks are still stuck, not moving. A lot of them 50% off the price that I bought them at, and you're at the same time sort of getting happy and getting excited right around the time. So I hope it comes with experience.
Well, we'll see.
Are you also paying? What's that?
I could be wrong too. But I think the evidence is supporting my case. That's all.
Are you also paying attention to whatever's happening with the currencies? I mentioned that at the beginning too, because I just mentioned the S&P and I was reminded to it, or maybe even the currency war, if you want to make it a little bit more doomsdaysy, as we call it. But today, by the way, I just learned that the Chinese yuan has overtaken the Japanese yen in its share of global currency payments. Not sure if it's true. I found it on Twitter, so take it with a grain of salt. But are you paying attention to whatever's happening with the currencies?
Absolutely. Well, this is all wrapped up in the geopolitical world we live in today. And I go back to go and look at the central bank purchases of gold. Okay. There's clearly a battle going on in the currency markets, which is the geopolitical battle against by China, Russia, and others against the US dollar. Okay. Where and that is a big part of this scenario for gold, okay? Because gold has had massive buying by central banks. And as I said a little earlier, if we get a turn here, which creates a little retail and institutional investor interest in gold, that incremental buying could really move gold, okay? So I think there is, and part of the scenario for an improved gold and commodity markets is a weaker dollar, which I think we're setting up for when rates decline. So yes, that is something all investors should watch very carefully, is the currency markets.
Right.
That will play into this commodity scenario.
But you're not necessarily buying the whole commodity-based currency or like a gold-based BRICS currency or something along those lines.
No, I don't play the currency markets. I mean, uh, I think they're better opportunities, like we're just talking about in the mining sector,
Mm.
that I'd sooner put my capital into.
Right, right. Okay. Well, what else is new this week is well, the last few weeks, maybe I suppose now, are the problems in the Red Sea causing shipping costs to spike. Actually, over 40%. I read an article this morning. Shipping costs apparently have spiked over 40% on some of the direct routes there. It's also estimated that since it all started up until right about now, which is Friday, over $100 billion in freight was our rerouting actually. So it seems like a big deal. Does that fit within your geopolitical currency type of assessment of what's happening?
Well, it's all wrapped up in this geopolitical issues we've got, with Yemen, attacking some of the freighters on in the Red Sea and so on. And I mean, it's just a continuation of the supply chain issues we've had, or an exacerbation of this already issue,
Mm.
supply chain issues we've had. So that's I don't know whether it plays out going forward. I mean, I have no doubt that the U.S. and other powers will rectify that, if they haven't already. So, is it a problem? Yes. Does it continue the exacerbate the supply chain issue? Yes. Does it matter? Because I think the supply chain issue has been a problem for a while. So I don't think it's incrementally a big deal. Um, because it's a topic that's been in the radar for some time.
Well, in that case, and when like the U.S. likes meddling into all these geopolitical conflicts, one argument I heard about that is that it is about the currency, and it is because that currency war is going on. In that, when the U.S. gives a trillion dollars or whatever to whatever country, I don't want to piss off anybody, but to whatever country they give $1 trillion, but that $1 trillion is going to have to be repaid. And for that country to repay that money, they're going to have to put upward pressure on the US dollar, demand for that currency. Um, and so some are arguing that the real wars are really related to the currency wars to support the US dollar. And if that's the case, with all the money that's been lent into existence from the US in the last couple of years, that's eventually going to have to come back. Is that something you're buying into?
Well, the flip side of that discussion is what's been going on in Africa and other developing economies with China, Russia, uh, countering and doing the same thing. Uh, with quid pro quos for building a power plant by the Chinese in an African state. I mean, it is a geopolitical war out there and it's played out in the currencies. There's no doubt about that. So yeah, the will try and work that side. The Chinese will continue, and Russians will try and continue to work their other side by co-opting, if you will, some of these smaller countries to join their side. Yeah, I don't think that's something new. I think it's something that we've had for some time and will continue, as we go through this battle, if you will, of
Hmm.
geopolitical powers.
And that battle that we're going through right now, as you said, is putting more pressure on the supply chains. And also with this whole shipping cost increase thing, um, could I mean, you said you expect inflation to keep coming down, and potentially, we're in a disinflationary environment, but potentially going to a deflationary environment. Is that really achievable with this world state that we have right now? Because if these shipping cost increases get translated into consumer price inflation, wouldn't that again put pressure on the Fed to keep rates higher for longer and therefore support the dollar? That's sort of among the lines of what I'm thinking.
Well, again, what I'm saying to you when I said about the problems with the shipping through the Red Sea, I don't think it incrementally is a big factor because the whole supply chain issue we've been with since the COVID shutdown.
Hmm.
So incrementally, I don't think so. In fact, I think we're probably going to swing the other way. If you look at the investment expenditures in the industrial sector of the United States, for example. Okay, and this is part of this geopolitical game that's going on. If you look at how much it's increased, and for good reason, the United States says, look, bring the production home. So part of the counter to the supply chain issues and geopolitical issues is the United States, largest economy in the world, they are reinvesting back in their own country to the deficit that China, remember China in the boom, for the Chinese boom, every US company was trying to create relations with China and produce in China where it's cheap, right? That money's coming home, okay? That capital is coming home. And if you go and look at the investment spending in the industrial sector in the United States, has just exploded on the upside. So there's a lot of yin and yang going on here with the supply chain. And I think a lot of the powers that be, major corporations in the United States that have had offshore production, they're reassessing all of that. I'm saying, okay, if not bring it back to the United States, let's bring it to Mexico or to Canada or wherever, which they can justify the perhaps increased cost against the geopolitical safety of having it closer to shore. Okay, that capital flow, and that's what I mentioned at the very outset of this conversation, that capital flow back to the domestic U.S. economy, I think will be part of the cycle that drives the demand for base metals.
That the topic of reshoring is probably a podcast in and of itself. I don't know enough about it to ask any intelligent questions there. Not that I do about any other topic, but what I'm mostly thinking about is that the supply chain issues and how they translate potentially into higher commodity prices. Because there's well, let me tell you where I'm coming from with this, is because China is once again in the news regarding its rare earths dominance, right? So whereas they had previously limited the exports of gallium and germanium, those are two rare earths, of course. Now they've completely banned the exports of those two metals. That was announced this week, and those two metals, by the way, are mostly used for the production of chips, and not like the chips that my wife won't let me have for dinner, but some computer chips. So again, China furthering its dominance over the rare earths market. Is this something like some type of a contrarian metal commodity that you see outside of the biggest ones that we talked about, sort of your gold, silver, copper? Is there something like a small metal that you're paying attention to?
Well, clearly the rare earths are important, okay, in so many aspects of the technological world we have today, and clearly, just I think the U.S. economy is starting to reshore for geopolitical reasons and supply chain reasons. There's no doubt about it. The U.S. and Canada have had a great focus on putting a policy together for critical minerals. Don't underestimate the United States when they, like when Pearl Harbor got bombed, look at their reaction, okay? China's shutting off supplies of critical minerals. Watch the U.S. reaction, okay? And so when I look at from an investment standpoint, I think to myself, I think I want to be involved in any rare earth opportunity in Canada, U.S., Mexico, any other safer jurisdiction, okay? Because the Americans have woken up that they need these materials, and they'll do whatever they can to help support the production of those materials in safer jurisdictions. So again, that creates demand, or it creates funding for those particular commodities in the mining sector.
I find that challenging because most of these rare earth companies are pipe dreams at best, if you can find it. So how do you deal with that? Like, how do you get exposure to rare earths?
They're challenged. It's challenging. It's not. It's very challenging to find economic rare earth opportunities. There are some. There are. We have a lot in Canada, but they do require a lot of capital and the right kind of metallurgy to get the production out of them. No doubt about it. But again, money can solve a lot of problems. And when you've got an intent and a critical strategic reason to get these materials to market from a safe jurisdiction, things usually happen. So,
Mm.
I think we're in that position right now.
Red tape will have a bunch of red tape will have to be removed though, in the US. And again, you said money can solve a lot of things, and when it's necessary, they can probably move. But what about some of the countries that are actually already doing that preemptively, if you will, like Argentina's Milei was or whatever his name is, however you pronounce it. Um, he's pushing for a deregulation of the not a complete deregulation of the mining space, but he's cutting costs for the mining space. He's cutting red tape. Is Argentina now a space that you focus more on since the elections?
I haven't particularly, no, but I'm not surprised that um, Argentina and other countries will do the same thing. Look, it's like when push comes to shove, right? Uh, Sometimes it takes governments a long time to wake up to the fact there's a problem, but once they get the sudden they go into high gear and say, "Oh, I I guess we have to do something now." And I think we're in that position with a lot of these critical minerals because they are strategically important, not just to technology, but to defense and other important sectors of the economy, okay, which are strategically important to the country. All of a sudden, it becomes not an economic issue, okay? It becomes a strategic, defensive threat to the union issue. And once you elevate it to that point, which I think critical minerals has, and Trump did this, right? When in his last year in power, one of the things, the personal opinion, one of the few good things I think he did do, but was he put together a policy around critical minerals, and so I think we're at that stage where it's not something that's being ignored, and I think their action is being taken, which I think is good for the industry. And that'll mean resolving some of the regulatory issues to try and get some of these minerals to market in the free world a lot quicker than they have done.
Get ready for the comments to be calling you a crazy liberal because you just said something about Trump that wasn't all positive. But we should get real about I dislike all politicians
Sure.
because they move their lips too much, and that means they're lying. But so tell you what's strategic for Europe right now. What has been strategic for Europe is not necessarily the critical minerals, not yet, but energy has been more top of mind these last couple of years. Our gas reserves are now stocked up, apparently, so there's little risk of us running out of energy. My gas bill is still pretty high, though. It's much higher than what it was in 2019. So that's happening. But we haven't really talked a lot about energy. Where does energy fit in your worldview for 2024?
Well, we're in a world of transition, right? I mean, how quickly is the green scenario going to unfold? How can it unfold? Um, we Trudeau here and the Canadian government just is trying to mandate the auto industry to produce a minimum number of EV vehicles. It's a pipe dream. It's just government policy gone amok. They just have no concept of how that's going to be implemented, but they just think they can just edict this away. It's just the world doesn't happen that quickly, and that's the situation for the oil industry. The oil industry is going to be with us for a lot longer than a lot of people would wish it would on the green side. It's just a fact of life. Okay. it will be, will transition to the green is on. There's no doubt about that. I think some of the expectations of how fast that's going to happen, I think, are unrealistic.
Mm.
So demand and at the same time, as you've seen, the reason oil prices and energy prices have gone up is the fact that there's no capital going into the industry. I keep saying this about the commodity sector. The commodity sector is all about supply. Supply is all about capital into the industry. When you starve the industry of capital, guess what? You don't get supply. And if demand, continues along and the supply drops, you get prices up. It's that simple.
Mm.
So I think commodity, oil and gas and energy prices in general probably stay elevated because you've got an industry that's not going to see a lot of capital invested in it to create new incremental supply. Therefore, prices will remain firm. So it's that. I think it's that simple.
And it goes back to what you previously told me. The more bearish everybody gets, the more bullish you get, and the world generally seems to be very bearish on oil and coal, and everything is bad. So,
Of course, I mean, listen, you've got the younger generation just protesting in the streets about a green economy. I mean, it gets a lot of press. The reality is there's not a lot of thought goes in behind that to say, well, how do we transition from here to there? There's a lot of linkages and issues that to get us to that goal, which are not thought through by anybody, let alone the government.
Sure. Well, now we've been through almost everything. Now that we've talked about energy, what else? What are we missing here? Something that you came here hoping to talk about but failing to bring up?
The simple message is I think the market for the metal sector is so bad it's good, and I think we're building a bottom here, have been for some time, and that I think we're can see the scenario in 2024 where we could see a bull market emerge for the commodity sector in general and for the mining sector in particular.